Welcome to the Daily Update, where I'll go over the action in the market for Friday, August 4th, and then we'll see how things look for Monday, August 7th. We had a pretty disappointing day, actually, especially if you're bullish on the market. So far, the support has been holding, but after having a nice open and really moving to the upside, about halfway through the trading day, we hit the top, and then the whole afternoon was spent just selling, and we ended up closing down on the day. We're turning more negative now, especially in the short term, but we're also oversold at the same time. We're turning negative in the intermediate term, but for right now, the long term is still holding up as long as we're above the 200-day simple moving average. The markets liked the employment situation report, and that seemed to make for a really good comeback. But after prices had gone up in the morning, the whole attitude seemed to shift. There wasn't really a cause for things to change. We just saw some selling right before a weekend in the summer. Before I get started, please know that I'm playing around with the thumbnails. I'm trying different kinds of things with those every day. What I'm probably going to do is post those on the YouTube community tab. If you have any interest in providing any feedback, please feel free to look at those, give it a like or a dislike, or if you want to leave any comments, that would be appreciated as I try to find something that seems to work. Also, I'm having a little bit more trouble with the computer that I use to do these videos with the power unit again. Right now it seems to be working, but it's been gradually getting worse. If for some reason the other videos that I do over the weekend, I have to go to plan B, I might have to use Zoom to record the videos, and usually those are unedited. But hopefully the computer will stay intact long enough for me to get those videos posted. Let's go back and talk about what happened. Right at the open, we had a gap higher, and we actually gapped above R1 at 45.19. Prices fell back, which is typical. We came back down to the daily pivot at 45.02 and to the unchanged level, and that was to fill the gap. And then we started going up after that, and it looked like, okay, we just filled the gap. Now we're going to get set to go higher. And prices rose back above R1 as well as R2 at 45.36. We even went a little bit above R2. But then everything reversed, taking prices back down below R2, R1, the daily pivot, the unchanged level. So then we went negative. We went below S1 at 44.85, and we closed almost at the low. But if you look at this on a closing basis, we were down 0.53%, not a really big move. But if you look at the intraday chart, which I'll show you here in just a second, it was really a lot more radical, with a positive opening and then a pretty negative afternoon. But volume was at about average, and we can take that on a positive side, saying that we didn't see a pickup in volume as there was selling, but on the other hand, there wasn't a real pickup in buying as we were going up. So our technicals are negative right now, but in the short term and a little bit in the intermediate term, we're oversold. The market continues to be worried about inflation and interest rates, and that actually gave some headwinds for stocks. As the market was going up, interest rates were going down. Interest rates kept going down, but stocks kept going down as well. And this is all about growth concerns and what's going to happen going into the future. What are some comments that we can make? The S&P reacted positively to the jobs report. It bounced off of the 4,500 level, and it's like, okay, that's a good round number. Maybe we can get set to go higher from here. As interest rates declined, and then there's a big but here, things reversed midday and led to intense selling, resulting in a close below 4,500. On an intermediate term basis, we have the PMO studies and the BPI for the S&P 500. Those still remain extreme positive, even though they're both declining. On a short-term basis, we're already oversold. We have a new chart on here that I don't get to show that often. The VIX based on 9 periods, the Stochh RSI, the Williams percent R, the CCI based on 14 periods, the stochastics, which had been showing overbought and oversold at the same time. Now it's pretty much negative and oversold, as well as the force index. On an intermediate term basis, we have the CMB composite looking extreme negative, and I'll have charts to show you of all these things. The dollar was down and interest rates were also down, which both of these should have given some support to stocks, but that ended up not happening. All of the yield curves that we follow still remain inverted. Sentiment is still positive. It had been near extreme positive at 74. If we ticked up to 75, that would be extreme. We dropped down to 69. Our trend is positive, and believe it or not, even with the down day, the green line is starting to turn back up. But the ADX is below its moving average. They're still well above 20. They're just coming down from 40. Our bias is negative and our momentum is now negative. The economic reports that came out, it was all about the employment situation report. Non-farm payrolls came in weaker than expected at 187,000. They thought there were going to be 200,000. Last time we had 185,000, and that number was revised down. Non-farm private payrolls came in just about what they expected at 172,000, up from the 128,000 we saw last time. The average hourly earnings were up 0.4%, more than the 0.3% they had expected. Last time it was up 0.4%. The unemployment rate ticked down to 3.5%. They expected it to remain at 3.6%, just like we saw last time. The average work week was at 34.3 hours, a tick down from the 34.4 that they had expected. Last time it did come in at 34.4. Here's some charts to show you. This first chart is really not all that helpful because we had the huge down move during the COVID lockdowns and then the surge back up, so it skews the rest of the results in this chart. Looking at the unemployment rate, it continues to tick down. What we're waiting for is when the unemployment rate starts to go back up at some point, as it usually does, then we should see the inverted yield curves that we've been watching. They should go back to looking normal. And then at that point, we start a countdown to see if we're going to go into a recession. So far, with the unemployment rate going down, we're not seeing that kicking into gear. The market's been waiting for that for over a year. The hourly earnings on a year-over-year basis are up over 4%. And then when we look at the change, we can see over on the right-hand side where it was little changed from the previous month. Here's when we look at the initial claims and continuing claims that we got on Thursday. The red line covers the initial jobless claims, and that's declining. We're also seeing a bit of a decline in the continuing claims. That's the blue line, and we're ticking down to 3.5% here with the overall unemployment rate. Looking at some IsabelNet.com blog charts, the average S&P 500 stock has moved either up or down 4.6% when they report earnings quarter to date. This is the highest that we've seen in a decade, and they're trying to measure this on an apples-to-apples basis. The light blue area is the implied move. That's what they thought was going to happen after earnings came out. The black line is what really ended up happening, and we even exceeded what they thought was going to happen so far in 2023. Also looking at a chart from Real Investment Advice, this is showing what is called the real S&P 500. That takes inflation into account, and we're also using the Robert Shiller CAPE on top of that. Overall, this is suggesting that stocks continue to be expensive on a historical basis. When we're looking at the Fed funds target rate, of course, you have what the Fed says they're going to do. That's the gold diamonds that you see here. That's what they're projecting. And then you have the market, which is the blue line. And then, of course, Bank of America has to come in with their forecast. Right now, they're about the same as the Fed, where the market is expecting it to be a little bit lower. And then we'll eventually see a trailing off going into the end of 2024. How much exposure to gold is there? There's been a lot of buzz around that. Gold had been quite disappointing. Well, we saw a little bit of resurgence in that. Folks like to jump into the market. It's showing that a lot of people continue to be in gold. When we look at the non-farm payrolls, now this is not updated for the report that we received on Friday. We are seeing a continuation of added jobs. When you compare that to the ISM manufacturing, which we did get earlier this week, we're seeing a real disconnect. These have a tendency to go in the same direction. We're seeing the ISM manufacturing dropping below 50. That's showing contraction. We're still seeing really healthy job growth. When we try to compare small cap and large cap, we have the Russell indexes that we can look at, where this is suggesting that small caps continue to be undervalued when compared to large caps. This would be positive for the market. If we get done with this decline, start going back up, we'll have to see, are the small caps going to start behaving better? In a good, healthy environment, we want to see the small caps going up with the rest of the market. The cash allocation right now is still below average overall as people are putting more money to work. We had the latest reading from the active asset managers. It's hard to see on here, but we got above 100 in our previous reading. We use this as a contrary indicator. Even though these are professional managers, because they're human as well and they have emotions, when they start to get really extreme, we start to look at the opposite happening. We've seen a bit of a drop, and now even in their own reading here, it's dropped to 78.46, and I'll also cover this in the weekly video. The next chart just shows the world debt, where we're well over $200 trillion in debt right now, and that continues to climb. Getting into our charts and analysis, here's the intraday chart. We did gap higher. We went above R1. It looked like, okay, positive open. Nice reaction to the employment situation report. What's very common is then we came back down to the daily pivot and to the unchanged level. So that filled the gap from Thursday, and then we started to go higher. We went back above R1. We actually got above R2, and it looked like, okay, maybe we'll keep going up higher. No, that's not what happened. We topped out, and then you can see all these red bars show pretty systematic selling going all the way into the close. We dropped below the daily pivot. We went negative. We dropped below S1. We never made it down to S2, but we closed pretty much at the low. Here's the intraday chart where we were bouncing around in the pre-market session as there was positive reaction to the employment situation report. We saw a positive reaction, and then the market opened and we shot higher, and then we hit the top and then spent the rest of the day coming down. We're pretty much flat now as the market closes for the weekend. Large cap growth did underperform large cap value. Both of them were down, but the red line was down less than the blue line. So on a closing basis, especially with the large caps, growth was down 0.88%, where value was little changed actually. For the mid caps, growth actually was positive, and we're seeing that internal strength still with the mid caps. However, for the small caps, growth did underperform. Here's the SPY growth to value ratio. We're below the unchanged level and declining. It never participated in the up move that we saw earlier in the day, so that's more negative. And I was watching this as it was happening. As we were going up and up and up, I actually saw where value was really outperforming growth, and I thought, oh boy, are we going to top out and start to come down? And that's pretty much what ended up happening. Looking at sentiment, our Ulcer Index has ticked up a little bit, but it's still below the moving average. We've seen the VIX really shoot up, both with the line chart as well as the bar chart. And when we look at the VIX of the VIX, the volatility of the VIX is really starting to pick up, both with the line chart and the bar chart. Then, this is a chart I don't get to show you all that often. This is the RSI on the VIX, where we're starting to show that we're extreme positive, meaning that the VIX has gone up pretty far, pretty fast. When we look at the 5-period moving average of the equity put call ratio, it continues to advance. That's more negative for stocks. And a longer term look at the same chart shows that we're back above the 0.55 level and rising, which is more negative. On the positive side, though, our longer term moving average of the equity put call ratio continues to decline. When we look at the MOVE index, bonds were really all over the place. They were down, then they were up. So we saw a decrease in the MOVE index, which measures the volatility of bonds. We saw an increase in the volatility of stocks. So when we look down below, they're still having a pretty strong correlated relationship. The VIX to MOVE ratio really shot up because of the decline in stocks and the increase in bonds. Looking at this fear gauge, it actually ticked down just slightly, but it has been rising as of the last couple of days. However, overall, it had been declining. Our other fear gauge, it's hard to see because it's so small, but it did tick up in Friday's session. Looking at the ratio between risk on and risk off, we did see a little bit of a deterioration in the ratio. However, this still continues to advance. Looking at our advanced decline line studies, we were down based on price and volume. We're still holding up okay. We're well above the moving average, and yes, you can expect this on a pullback, so not a lot of damage has really been done, at least yet. The new highs, new lows. When we were really up in the morning, that increased the new highs. As we were going down, we saw a little bit of an increase in new lows. Our 5-period is rolling over, and our 10-period also continues to decline. The advanced decline ratio, the blue line, which is the faster moving line, it's now dropped below 0. The red line is declining and continues to be above 0. Accumulation distribution, this is what we were watching earlier on. When we saw this drop below the moving average, well, it trailed off even a bit more in Friday's session. The cumulative NYSE advanced decline line did show some more weakness, but it's still above the moving average. We saw actually a tick up with the overall NYSE advanced decline line. And that's a really strange looking trend line there. I'll have to fix that. When we look at our other advanced decline line for the NYSE, we are still above this upward sloping trend line. When we look at common stock, we saw a bit of a decrease based on price as well as volume. Longer term, we're still seeing this negative divergence where we had broke out based on price. We ended up just going up to the previous high based on volume, so that is a little bit of a negative divergence. We saw a little bit of a breakdown with our advanced decline line studies where everything fell but still remains above their moving averages. Looking at the trend, here is where we're seeing the ADX dropping below the moving average. That suggests the trend is weakening. but we saw the green line turn up just slightly and the red line turn down, so that's still leaning a little bit more towards the positive. And when we look at the shorter term ADX, we are below the moving average. The green line ticked up and the red line ticked down slightly. So we're just hanging on by a thread to a positive trend, but it is a weakening trend. Volume continues to be just about average. Looking at some short-term charts, where we initially got above this pivot level, well, we ended up closing down below it. On the bottom, you can see where volume was just about average. Looking at our 20-period double and triple exponential moving averages, we are showing more short-term weakness. We've fallen below both of those moving averages and continue to decline, and now the moving averages are starting to turn down. And when we look at our 20-period simple and exponential moving averages, we've now dropped below that. The next line of defense would be the 50-period moving average. When we look at our moving average study, we're declining with the 20, the 50, and the 200. The Stochk RSI is still extreme negative. The Williams percent R is also extreme negative. The CCI 14 is extreme negative. The stochastics in the short term are extreme negative. We're now extreme in the intermediate term, and we're no longer extreme positive in the long term, but we are declining. The force index is still down near the lower end of the Keltner band, meaning that we're going down pretty far, pretty fast. Some intermediate term charts. The balance of power has now dropped below the dashed line. That's turning things more negative. The CMB composite has now gone extreme negative. So far, that's one of our only intermediate term signals that we're watching. And this is a little more touchy. I could almost include this as a short-term indicator. We're dropping below the double and triple 50-period exponential moving averages, and now they're starting to roll over as well. The go-no-go system, though, still remains more positive. We're turning to a lighter color blue, but this is more of a neutral blue. We're coming down to the lowest low value now. We drop below the midpoint and we're starting to see a decline as these lines are beginning to roll over. The TTM squeeze also showing some weakness. We have the darker colored blue bars and the oscillator is declining. We dropped below the midpoint with the standard deviations chart, and I tried to change this to make it a little easier to see, where we're coming down into the 1 standard deviation. If we keep falling, we're going to go down into the 2 standard deviation. The ease of movement has now dropped below 0. That's more negative. The Arun indicator is rolling over a little bit. It's seeing a decrease in buyers. Sellers are flat, so the overall reading shows that this is coming down slightly, but it's still positive since we're above the 0 line. When we look at the 20-period simple moving average of the open, high, low, and close, we're dropping below these levels that sometimes can act as support. Not always. There are times when we fall through and then end up coming back through that. But right now, we have to see this as more negative. The S&P McClellan oscillator continues to decline, and we're getting close to that extreme negative reading. So when we look at the summation index, we're now going lower based on price as well as volume. Please keep in mind that volume turned down a few days before we saw that in price. The NYSE McClellan oscillator actually ticked up a little bit, so the broader market was a little bit more positive than the S&P, but this is still negative. So with our NYSE summation index, we saw a decline based on price and volume. The Swenlin trading oscillator is dropping below 0 based on price and volume. That is negative. The PPO, after giving us an extreme reading, is now starting to roll over. Also keep in mind that we saw that based on the price and volume readings before we saw that in the PMO. Sometimes they can give us a heads up. Our PMO study, we're starting to look more negative with the PMOs that are rising. We're declining with the buy signals. We're still just barely extreme positive with the percent of PMOs that are above 0, but it is declining. The Elder Impulse system for the S&P remains negative with a red bar. The parabolic SAR, this is a big one where we have dots on top for 3 days now. The slope oscillator is now declining. That's our shorter term oscillator. The MACD is also looking more negative. So when we look at all of our oscillators, we're negative in the short term. We're also turning negative in the intermediate term, and we're starting to see our longer term oscillators rolling over negative. The Sean trend meter is no longer extreme positive, but it is declining. The bullish percent index still holding up. We're above the 70 level, but it is declining. The NYSE bullish percent index is also starting to roll over, but it's still above 50. The Chaikin money flow, this also gave us a bit of a heads up. We were seeing a decline in buying by the smart money. Now we're dropping below 0 and going more negative. The Chaikin oscillator is also turning back down and looking negative. The money flow dropped below 50. That is negative. The vortex is just about ready to cross below the red line, but we saw a little bit of a decrease in the red line. The ultimate oscillator below 50 and declining. The RSI, after seeing this longer-term negative divergence and then a shorter-term negative divergence, we're now starting to see some weakness. The 14 period is below 50, where we're dropping below 50 with the 9 period RSI. On-balance volume is declining, but we're still above the moving average. When looking at our 200 period moving average study, we're seeing a decline, as well as with the 50 period moving average study. The Pring bottom fisher, it's rolling over, but it's still generating a buy signal. Some line chart studies, we dropped below this shorter term trend line, and we're kind of in no man's land wondering, are we going to turn and go back up, or are we going to come down to this next trend line, which still is at about 44.50. Another thing that gave us kind of a heads up is that we started a new cycle on August 1st. It looks like we're continuing to decline. Is this going to continue throughout this 50-day cycle? That's what we're asking now. Our different charts looking more negative here. The Heiken Ashi is now negative. The Kegi is now negative with a red line pointing down. The Renko is now starting to show some negativity with a red box. And the 3-line break is starting to look more negative. Our different indexes, we saw weakness both in the equal weight and the S&P 500. The ratio between the two really didn't change all that much. When we look at Dow theory, we saw a decline in the Dow, a decline in the transports, but they're still above where they broke out. We're seeing some real follow-through weakness in the utilities. When we look at the transports to S&P 500 ratio, this actually went up. And in the background, this could be more positive. The transports continue to outperform the Dow. When this ratio is going up, that means the Dow is outperforming. When it's going down, that means the transports are outperforming. When we look at our discretionary and staples equal weight study, we actually ticked up a little bit. Both were down. Discretionary was down less, and we continue to be in an uptrend. This could be another background positive signal. The Dow, even though it was down less than 0.5%, it's still above this pivot level. The diamonds, though, remain negative. The NASDAQ, we came right up to this pivot point, and that's when we started to see the selling coming in, and we closed pretty much at the low. That's never a good thing. We're still above this other S1 level. We also came down to the 61.8% retracement level. We were just a little bit above that. Please keep in mind that I draw these lines myself, so the figures may vary slightly. We bounced up off of that, then we ended up coming right back down to this level near the close. The cumulative new highs, new lows for the NASDAQ continuing to show weakness, even though they were trying to turn up. When we take the new highs minus the new lows, we're now continuing to drop below zero. We also came right down to the August 2022 high. Is this going to hold the support? So far it is. Are we going to be able to go up from here, or are we going to fall back down below this? The elder impulse system for the Qs remains negative. And we're also looking negative when we look at the PPO. We were seeing this negative divergence. It seems to be playing out right now with the follow-through negative price action. The bullish percent index for the NASDAQ 100 continues to decline, but we're still above 50. This is still negative overall after giving us an extreme positive reading. The ratio between the Qs and the diamonds continues to be holding up fairly well. The thing that struck out to me is we're seeing the Qs and the diamonds going in the same direction now when we look at the correlation. The small caps were barely unchanged. They actually held up better. We're still above this pivot point, but when we look at the Elder's Impulse system, they still remain negative. We're also looking a little more negative on this chart where the RSI is dropping, but it's still above 50. The MACD is now turning negative. And then after we broke above this resistance level, so far we've been declining since that time. The ratio between the small caps and the S&P 500 did show some improvement, but continued to decline overall. We want to see this ratio really going up and then supported by the S&P going up. That would promote more of a healthy environment. When we look at small cap growth versus value, it did tick down slightly. It's still in a longer term uptrend, but shorter term it's been going sideways to down. The mid caps are holding up okay, almost unchanged on the day. They're still above this pivot level, but the Elder's Impulse system remains negative. When we compare mid cap growth to mid cap value, it did decline. It's dropping below this moving average, but it's still in a longer term uptrend. The FANG index also flirting with its 50-period moving average, but not quite there yet. After creating a new all-time high, we broke down below that. We were trying to go back up, but then we ended up finishing near the lows for the day. The banks, though, are looking a little bit better. They're still above the 200-day moving average, and we were able to close above that level, even though we're in a longer-term downtrend. The financial sector is now generating a golden cross. We're seeing a little bit of improvement when we compare the financials to the S&P 500, but it's still in a longer-term downtrend. When we compare the regional banking ETF with the financial sector, we are seeing some improvement in this ratio, but it's still in a longer-term downtrend. Keeping an eye on bonds, they really shot down based on yield after going above 4.2%. And when the yields go down, that means price goes up. But we're seeing a death cross here when the 50 crosses below the 200. We did see an improvement with the RSI. The MACD is turning back up slightly, but is still negative. So we're getting kind of a mixed picture from this chart. Believe it or not, we actually saw a bit of a decline in this ratio, but overall it continues to go up. In a more positive environment, we want to see this ratio going down. We're also well above where we were at back in 2007 with our 3-month yield. Some long-term charts. We're still positive with the daily special K chart, even though it's rolling over slightly. We're coming back down and no longer being extreme with our 150 and 200 period moving averages. I'm sticking this in the long term because this is a weekly chart. With the PPO studies, we're still positive in the long and intermediate term. We did drop to below 0 with the short term. That could be a bit of a warning sign. We're now down below this resistance level where we were camped right on it after Thursday. And we're seeing pretty much that same thing with the NASDAQ 100 resistance level. We're also keeping an eye on this. This is longer term negative. The ratio between the NASDAQ 100 and the Dow, after giving us a really high reading, it continues to decline. But this is a weekly chart, so this can take some time to play out. And it doesn't mean we're going to go straight down necessarily. You can see other times with this ratio, it's more like a jagged line looking like a crazy EKG reading. An update of our possible positive scenarios. Well, we're seeing a lot of weakness here. The Qs are underperforming the S&P. Discretionary had a fairly good day and actually went above the moving average, but large cap growth is underperforming large cap value. When we look at our growth to value ratios, large caps flat, seeing decreases with the mid caps, and also pretty weak with the small caps. The S&P to utilities ratio is continuing to advance. That could give some more background support to the S&P as we're seeing weakness in utilities. We're still above 0 when we look at the broad range of the 5-period moving average of the highs minus the lows, but this is declining. We're also dropping a little bit with our 10-day average of the S&P 500 highs minus the lows, but we're still in this extreme positive area. If we see follow-through weakness, we're going to be seeing if this indicator continues to drop. This is also a little bit more negative. When we look at the 19-day exponential moving average of the advanced decline ratio, we drop below 0 based on price and volume. The 50-period exponential moving average of the new highs, new lows is turning down a little bit, but it's still above 0. We drop down below the moving average with our indicator, and that's causing the red line to roll over slightly. When we look at growth versus value for the S&P, it's still in a longer-term uptrend, but more intermediate to short term, we're seeing some weakness. The Staples to S&P 500 ratio did tick up a little bit, even though it's been declining overall. To give more support to the S&P, we want to see this ratio continue to decline. So what's our outlook for Monday? We will get a whole slew of earnings reports that'll have some impact on the markets. There's no scheduled Fed speeches for the month of August. Our technicals are negative, but on a short-term basis, we're oversold. We've got a pretty long list there, and we're turning more negative in the intermediate term. So far, it's only the CMB Composite Index that is extreme negative. We will be getting consumer credit on Monday. That's the only report coming out. We're also keeping an eye on all the different geopolitical events. We'll have to see what the market does over the weekend when they fall back and regroup. Are we going to continue to see more selling? Or after the 3 days of declines, are people going to come in and start buying the dips, as a lot of people like to practice? Here's the economic calendar for the upcoming week. The important ones will be CPI on Thursday. That's our inflation report. And we'll get PPI on Friday. Looking at the Stock Traders Almanac statistics for August 7th. We are neutral to positive with the Dow and S&P, where we're pretty decidedly negative with the NASDAQ. We're also wondering, are we still in that seasonal time of weakness, especially for the NASDAQ, which also influences the S&P 500? We will be on the 5th trading day of the month, where sometimes we see a little bit of a bounce from here in pre-election years. Can it happen again this time? Going back to 1950, we're up and down 50-50 as far as the S&P is concerned during pre-election years. Looking at our scenarios, we're going more with the down one right now, but please be aware, we are oversold in the short term. That could produce some kind of a bounce. And we're not going with the sideways trend because the ADX is below its moving average. It's still above 20, although it continues to decline with the green line going back up. But overall, it's still suggesting we're in a strong trending environment. The warning signs. We did see a convergence of these shorter-term bearish signals, and they all kind of started coming together, and over the last few days, they've had a real impact on the market. Those longer-term trend signals, the top for the S&P weekly chart and NASDAQ 100 chart, they could be signaling a top. So far, even though we dropped a little bit below that, this level continues to hold. We're still wondering, is the seasonality and historically weak time that we're in right now, is that going to continue, or are we going to start to come out of that? The oscillators that we follow for the S&P are negative, and we're keeping a close eye on the NASDAQ 100 oscillators. The VIX is still showing that there's not a lot of fear in the market, even though it is starting to climb. The cumulative new highs, new lows for the NASDAQ are still showing weakness. We're still above the 3-month yield where we were back in 2007, wondering, is that some kind of a warning sign if we see that yield start to come back down? Right now, it's continuing to rise. S&P growth is weakening, but it's still in a longer-term uptrend. The weekly pivot has acted as overhead resistance. We hit that last week, and we pretty much have been coming down ever since then. The parabolic SAR is negative, and then earnings season can be either positive or negative. The positive signs, way in the background, we have this seasonality and setups that apply to the whole year. At some point, the market might be able to latch back onto those. The long-term daily special K chart is positive, but the weekly chart is negative. The long-term equity put-call ratio is positive. The S&P remains above the downtrend channel upper line. We're still far away from that line. We're still in a risk-on posture, even though we saw a decline in that ratio. Lower price levels, we still are above support levels that we'll be keeping an eye on. Will this hold going forward? The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they broke above overhead resistance, and they're still above that, but they can't get above these daily pivot resistance levels. And if we start to fall, these levels that we broke out above, will they provide support? The Staples to S&P 500 ratio continues to decline. The Russell and small cap index, as well as the mid caps, are still working off of recent golden crosses. Small and mid cap growth continues to be in a longer term uptrend. The Pring bottom fisher, even though it's rolling over a bit, has generated a buy signal. The financial sector has generated a golden cross. So our conclusion, the S&P is negative right now. We're still above some support levels. Will these support levels hold? If we break through those, things could turn a lot more negative. In the short term, we're negative, but we're oversold. In the intermediate term, we're just plain negative, but we still continue to be positive in the longer term. Thank you. I hope you have a really nice weekend, and I hope to talk to you in the next video.